First, thank you all. Good evening to everyone. And thanks to IAICC for arranging this great event. And also thanks for all the attendees. Appreciate it. It's Tuesday evening. About myself, my name is Thangavel, part of InvestNJoy Capital Company. And here I have Daniel Twito. He's my partner. So we both work together in the InvestNJoy Capital. And today, about myself first, I will introduce myself. Yeah, so quickly, our agenda. So we are going to have the quick team introduction. Then we are going to exactly just explain about the current business problem. And then we'll go through the big, beautiful bill. And then we will just show one of the offerings currently we have. And with that first quick introduction about myself, I'm the CEO of the InvestNJoy Capital and also InvestNJoy Residential. We are a multi-family owner and operators. We own and manage apartment complex in state of Texas, specifically in the Dallas-Fort Worth area. And last 15 years, we are doing this real estate. And my original background is IT. And from IT to I transitioned to real estate. And my partner Daniel will quickly introduce. Go ahead, Dan.
Yeah, thanks, Thanga. And thank you, Doctor, for having us in this great event. And thank you, everybody, for being here and listening. Hopefully you learned something new and exciting. So like Thanga mentioned, we've been partners for going on 8 years in InvestNJoy Capital. And my original background is as an engineer. I went to school at the Merchant Marine Academy. And then through engineering, I found my way into real estate. And I found that to be a pretty powerful opportunity to grow wealth. So together, Thanga and I have built a multifamily portfolio of about 1,300 units in Dallas-Fort Worth, a little over $200 million in assets. And hopefully tonight you get a chance to learn something. We'll talk a little bit about like common problems and what people face, what busy professionals face and business owners and things like that. And then we'll get into, some specifics on how the big, beautiful bill will actually impact your potential situation. So what is the problem that we're all facing right now is that we're trading our time for money. We're not getting our money to work as hard as we are. So you're working hard, you're making a high income, but taxes hit hard, or time is limited and your schedule is demanding. So you don't have the time to really figure out the right strategy to get your money working. Lots of people are trying stocks and bonds, 401ks, mutual funds, but you have high fees, there are low returns, it's volatile or somewhat confusing. And many people want more wealth with less work, more wealth without the burnout. How can we get our money working for us and not just take more risk, but actually find the lifestyle we're looking for with less risk, where you're not having to look at your portfolio every day. And so what's the solution? And what Thanga and I have been working on for the last 15 years is in real estate. How your money should be working for you. What you should be looking for is truly passive income. Earning money while you sleep, and why specifically real estate? It's a hedge against inflation. You have real estate values and rents typically rise over time, just slowly over time. You have tax efficiencies. You're using depreciation and the law to legally lower your tax bill. You get time freedom. As a business owner yourself, the last thing you want to do is add more to your plate. Or as a busy professional working for a corporate company, the last thing you want to do is add more to your plate. So how can you add more money in your pocket without more work to your plate? So time freedom. You're not doing any of the landlord duties. You can put your money to work with a fully managed professional team. And then this is a way to diversify your income and spread out, putting eggs in different baskets, as Warren Buffett might say. And then compounding returns. And one of our partners and investors, Dr. Francesca Byrne, this is something that she saw even as she was making such a high income as a doctor. She found that she was, as a full-time physician, She needed to find another investment vehicle, finding a different income stream in order to help her build long-term wealth. So she chose multifamily real estate. They've worked with us on a couple of projects and really helped supplement their income. So this this may not apply to everybody, but for some of you, you may be feeling like, hey, I'm making a lot of money, but every dollar I make, I'm just making more money for the government. You know, every dollar I make, you know, they're taking half or something like that. And you have less time to do what you really want to spend your time on. And when you get into multifamily real estate passively, you have an opportunity to make an additional stream of income. You make passive income, you get tax benefits, you can lower your tax bill and create more time freedom for yourself. And this is why a lot of busy professionals and busy business owners invest in apartments. Tax advantages through depreciation and cost segregation, which we'll talk about. The big beautiful bill made some extreme changes to that and really beneficial for investors and business owners. Real estate's a hard asset. It's tangible. You can go there. It's stable and recession resistant. You know, during COVID, we really found out what things were necessary for survival and what things in the economy didn't need to be there. Monthly distributions and cash flow, market and forced appreciation. So as time goes on, the market appreciates. You can also force appreciation through value add. You're building up equity. The residents are paying the loan down for you. And then, like I mentioned, it's a hedge against inflation. And one of the powerful things we're going to kind of talk about a little bit today is the idea of group purchasing. So economies of scale, when you work together, like this group is trying to build more members and create more leverage for each member and each business partner in the community to give back and work together for more good. That's the same thing in real estate. You can group together and buy a larger apartment building in order to get the economies of scale. And one of the powerful things, you can use a self-directed IRA or a 401k to invest. So if you have an old employer IRA or 401k, you can actually use that vehicle to invest in real estate passively. And this generates completely passive returns. It's very powerful. And so it's a common theme, but many business professionals, doctors, physicians, business owners are turning to real estate. And really it's because, you know, there's a lot of pressure. There's a lot of burnout. Tax pressures are at all-time high. You're working harder, but not keeping as much in your pocket. You're finding industry specific groups popping up to invest in real estate. The inflation is still there. So every day that you wait, your dollar is losing value as inflation continues to come. You know, tariffs and interest rates are moving a lot of capital to real estate. So what can we do? What's the opportunity? So a lot of times when you have a problem, when you have a challenge, that's the opportunity. That's the time you can take advantage of the situation. So if you're sitting on cash, put it to work. Real estate stable, inflation hedge against inflation. And you don't need to wait for the perfect time. Although real estate cycles, like anything, are cyclical, it's very local to a certain demographic or location. So it's very local. You can find opportunity in any environment, whether the environment is very hot or very cold. And right now, the environment's a little cold. And this is probably one of the best opportunities to invest in real estate. So there's great opportunities when there's market uncertainty.
Yeah. Okay. First, before we get started, we are going to jump into this one big beautiful bill. We want to make one disclaimer. We are not CPAs. We are not tax attorneys. We are real estate professionals, and we estimate and provide our best information for you all. This is for information purposes only. Always you have to consult individually. Always any tax situation or anything, it will vary based on individual circumstances. We want to just make that disclaimer for you all. Go ahead, Danny.
That's a good point. Everybody's situation will be different when it comes to their personal taxes because they have so many different things going on in the tax bill. But this is the part of the presentation that we want to share some of the changes that have happened in the one big beautiful bill that just got passed. So one of the major tax advantages to investing in real estate is depreciation. And what that means is that over time, a real estate building depreciates, and those depreciation factors, you're able to offset your taxes. And what happened in the One Big Beautiful Bill is that President Trump signed into law 100% bonus depreciation coming back through 2029. And so what does that mean exactly? So you're able to write off the physical parts of the building in year one. So bonus depreciation means you can take that depreciation that you would normally do, have a lifespan of 5 years or 7 years or 10 years, 15 years, and you can depreciate, you can compress the timeline and take all those tax losses in year one. So why would that matter for a high net worth individual or a business owner? So the reason is because when you invest in real estate, so the government creates the IRS tax code to incentivize you to do what it wants. The US government wants people to invest in real estate. It wants people to invest in multifamily housing because it's a basic necessity. We have to have it. So they create this tax law to give you massive tax losses, so paper losses that you can write off your personal taxes with. So here, as an example, a lot of times when you invest into a real estate project that we have, let's say you invest $100,000, you would be a partner in the deal in terms of getting a K1. As a partner, you get a Schedule K1 at the end of the year for the tax purposes, and that K1 may give you a negative $60,000 in a tax loss, a paper loss. Now, like Thanga mentioned, how you can apply that to your own personal situation may vary, but that $60,000 may offset your taxes in a very powerful way. A lot of people invest in real estate from their other business income, specifically like only for the tax losses. They're looking at the returns, great, but specifically they want the tax losses. So you can offset your other income. So you're making money passively, you have cash flow, plus you're getting the great benefits of depreciation and tax losses.
Yeah. One point I want to make, this 60,000 is estimate only. This may go up based on the properties and based on number of units and everything, just for your information.
Yeah, 60,000. Could be more, could be less.
Yeah.
So One Big Beautiful Bill. And we're only going to touch on a few of the key points from the tax bill. So we're not going to cover, it's a long document. We're not covering everything. These are specific to real estate and why it makes sense for you as a business owner or considering real estate investments. So one is called a Section 199A. It's 23% pass-through deduction. And that increased, it was already there, but it increased from 20% to 23%. So you're just getting an additional benefit from before. But what that means is that as a business owner, through your business, you're now receiving a 23% deduction. And why that matters is most real estate investments are held in a pass-through entity. So this automatically lowers your taxable income, even if you don't take on new expenses. So here's the example. And this is a small example. Our multifamily properties are generally have a lot higher revenue. But as an example, if you had an LLC that earned $200,000 in net rental income, the immediate deduction that you're allowed to take is $46,000 right off the top. So it used to be 20%, now it's 23%. So that means you're paying less taxes and keeping more in your pocket. And the whole purpose of the One Big Beautiful Bill is to encourage investment. It's to encourage people to put money to work. So they get working in real estate. They get working and putting their money to work. They're not sitting on the sideline. So another key tax change to the One Big Beautiful Bill is that the state and local taxes. This may actually benefit a lot of you, depending on which state you're living in and how much taxes are in your state, property taxes and such. It reduces the deductions, or it increases the deductions you can take from $10,000 to $40,000, which is massive. So if you live in a high state income tax or property tax, or you own multiple properties, you can now deduct more from your personal income taxes for the federal return. So here's an example. You pay $18,000 in state income tax. you pay $14,000 in property taxes and you pay $4,000 in local taxes. So this may look like somebody who makes, you know, $100,000 or $120,000 or something like that, maybe more, $200,000, let's say. And they have a $500,000 house. This could very well be somebody in Texas if we had state income tax. So your total taxes between your state income tax, property taxes, and your local taxes is $36,000. Which is all fully deductible. It used to be only $10,000. Now the new cap is $40,000. You think you're getting an increased benefit of $26,000. So some of you may be doing your own taxes. Some of you may have a CPA. Make sure that you are getting with your CPA or reviewing this types of stuff and finding out how this will actually affect your tax return, because it may be really beneficial for you and keep more money in your pocket.
Yep. One more I want to add, when this one big beautiful bill starts, right, from January 2025 onwards, if we bought a property in after January 2025, then you are eligible to claim these tax deductions in this year.
And one of the other key changes that mortgage interest deduction became permanent in the tax law. So it was already there, but they made it permanent. And this allows you to deduct your mortgage interest on up to $750,000 of a loan. So you have to have a home loan on a property, and the interest that you're paying on that mortgage, the mortgage interest, is deductible. So why that matters? More tax losses. More tax losses. That's the best part. That's why the one big beautiful bill was created. It was created to put more money in individuals' pockets. So if you pay, let's say, $42,000 in an annual mortgage interest, you can deduct the full amount. As long as the loan that you're paying that mortgage on, that mortgage interest, is $750,000 or less, then you can take less. Now, one question you may be asking, what if my loan is $1 million? Or what if my loan is $3 million on a primary residence? Well, you can still take mortgage interest deductions, but it's only on the $750,000. So let's say you own a house, or you have a house and you have a mortgage loan for $1.5 million. So now your annual mortgage interest is $84,000. Well, you can take the deduction up to the $750K, so about half of it. So it will be the same $42,000 savings or tax loss. And so here's one that may strike those who have a business. So this one specifically helps us as multifamily real estate investors. This was something that the Biden administration had changed earlier, and it's why a lot of businesses that put on high leverage bridge loans, they were not able to take the interest deductions in that year. And so they got something called phantom income. So people they were not making any money in the business, and they still had a tax liability because they were not able to take the interest deduction. So the big beautiful bill changed that. Not entirely, you can't take the full interest deduction, but you can do more than you could before. So it increased the limit on the business deductions that you're allowed to take. And why that matters? For real estate investors, for real estate business owners, that matters because that's how we're actually taking our interest losses and calculating our taxes. So here's an example. In the previous tax law, if you made $1 million in your partnership and you had interest expense of $300,000, under the old law, you could only deduct $120,000 out of the $300,000 in your taxes. And under the new law, so under the new one big beautiful bill, you're able to take $180,000 out of the $300,000 of interest expenses. So you can just think about it on a larger scale. If you have a large loan, you're talking about a really large number, like 10x that number, right? Go from $1 million loan to $10 million loan, or your partnership makes $2 million and the interest deduction is goes up $120,000. So you can see, rather than spreading out that income to all the partners, you're now able to deduct that. And now people don't get the phantom income, and you're able to write off more interest expense on properties that use leverage, which the majority of real estate investors are using some leverage. It's one of the powerful tools for multifamily real estate.
And
So those are all the pieces of the one big beautiful bill. There are some additional items in the one big beautiful bill that are helping people out, business owners, other industry specific items. It's a long bill, but these are some of the key ones for real estate investors, how it might impact you if you consider investing in real estate. And with that, I'm going to talk a little bit about our background and track record. So just a little bit more about Thanga and I and our journey. So this is what we're typically looking at when we're analyzing, when we're underwriting multifamily real estate opportunity. And these are the sold projects that we've had in the market. So, just to give you a little snapshot, over the last little over 11 years, 12 years, there's 6 properties that we sold across Dallas, Fort Worth, and you can see, we're generally underwriting properties to hit an annual return on investment somewhere between 15 and 20%. And which is great. If you're looking at the long-term average of the S&P 500, and that's somewhere between 8 and 9%, private equity, maybe somewhere between 12 and 13% or 10 and 11%, something like that. Multifamily real estate, over the long term is probably somewhere in the 12 to 13%. So over the last, handful of years, the projects that we've gone full cycle on, that we've sold, are beating the market. That's called alpha, beating the market by a long shot. 27% return on investment. That's an annualized number. So if we held the project for 3 years, you can multiply those numbers by 3 or multiply them by 2 if we held them for a shorter time. And these projects we typically hold for 3 to 5 years is the typical project timeline. You have to get in there, improve the operations, add value, and then look for an exit opportunity when the market is right. So these are the sold projects. This is our current operation. So you can see we've got about 8 properties in the Metroplex, all over Dallas, Fort Worth, and a little over 200 million in assets. These are just projected ROIs. We haven't sold any of these projects. So until we sell the project, it's hard to calculate exactly what the potential return will be. But this is what we're expecting right now. And then, we would be doing a disservice if we didn't give you an opportunity to look at something that we're working on right now. So this is one of our current projects that we're working on. It's called Western Station Apartments. And this is a Class A property in a great part of Fort Worth, Texas. This project is on the north side of Fort Worth, and it has all the Class A amenities. It has 2 swimming pools, 100% attached garages, a business center, gym. So you can imagine if you go into a nice apartment complex and you're looking for kind of like your work, life, play, style apartment with all the right amenities that is competing with the new construction projects, but for a lower cost, this is exactly what you're looking for. So it's a great property. It has a clubhouse, cabana, so for the residents, they can host a party or anything like that. They have a dog park, and then the actual units themselves are very unique. So they're all townhomes. They all have an attached garage. So you drive home from work downtown Fort Worth, you drive home and you go straight in your own garage. So let's say it's in the winter time and it's after 6 o'clock, and so it's already dark. You don't have to worry about driving and parking out on the street or something like that. You drive right into your own attached garage, and then you can go in your own bedroom. So it's pretty fantastic. And a little bit about Western Station, like why we're offering, or what makes Western Station Apartments, what makes it special. So it's a safe preferred investment, which means you're in the capital stack. You're basically in a preferred position in the deal. You're getting paid in front of the common shareholders and management, right behind the lender. And what that means specifically, like if you can think about Warren Buffett, he's kind of the the best example of who to follow. He always buys stock in the preferred class. So if something happens to the business, the preferred class always gets paid. So that's where he puts his money. So this opportunity for a real estate opportunity, apartments, is similarly placed. Like, you're getting paid in front of the shareholders, in front of the management, and right behind the lender. So first the lender gets paid, and then investors in this package get paid next. The property is already stabilized. It's already cash flowing. We've already started to do distributions, so we're already sending monthly distributions to investors. We closed on the project in February, and we're raising just a little bit more money for the project. So we already did distributions in April, May, June, July. So if you're looking for truly passive income, mailbox money, something that you can earn while you sleep, this is it.
And
So you're getting a great return on investment, 15 to 17% annually based on cash flow and the additional profit at sale. The project itself has a 100% property tax abatement, which we're already taking advantage of and approved for. It's fantastic. Like I mentioned, the project, real estate is very local, and not only is it local, but location is, it's an old idiom, but it's 100% true for real estate. Like, it's really, really important where exactly the property is. Does it get, eyes on the property? Are people driving by? Is it on a major road? Is it getting the looks it's getting? Is it close to local businesses and opportunity and jobs? Those are really important. And it's in a fantastic, irreplaceable location. So much so that a new property across the street was built. Right across the street, a brand new A-class new construction property was built. People don't build new properties without there being demand or without there being an opportunity. And the current appraised value is very high. It's 51.9 million. And the reason why that's important to know is because the preferred class, the last dollar of the preferred class is $38 million. So you can kind of think like, okay, my last dollar of investment is at $38 million, and the current appraised value is 51.9 million. So you can see there's a really large gap between the appraised value and the last dollar of your investment, which means you have $13 million of cushion, of buffer, where the common shareholders are and management are as well. So your investment is very, very safe and very, very low risk.
And
so how the deal is structured is it's a preferred return class. There's 3 classes based on the investment amount. So there are class A, B, and C classes, 50K, 150K, and 250K. And really the difference is just in the annual return that you're going to receive. So like I mentioned, you already have a monthly distributions happening, and you have 8% for class C, so 50K investment. You have 9% annual cash flow for class B, and 10% for class A for 250K minimum. So, based on your investment amount or ability to invest, you can generate those returns. And then the additional 7% is on an annual basis. So you get, let's say we sell it in year 3 and you're a class A investor, you would get 10% per year plus an additional 7% for the additional 3 years. So another 21% on the back end. And this is what the property looks like. So we'll share a little bit more later, but this is a class A property. You can see like nice brick exterior. You can see the clubhouse. You can see one of the pools. This is the pool by the office, and townhome style with all the attached garages. And so here's the leasing office, the back pool. So it looks almost like new construction: quartz countertops, stainless steel appliances, new cabinetry, new lighting, flooring, things like that. The difference is the cost. You're charging $1,300 for a 1-bedroom for our property, and down the street they're charging $1,500 for a new 1-bedroom at the new construction property. So it's very competitive. So here's some more pictures of the interior, what these units look like. And we want to invite you, if you're wanting to learn a little bit more. We share more information. We have a newsletter. We share opportunities that we're working on. If you're local to Dallas-Fort Worth, or even if you're not local to Dallas-Fort Worth, we host bus tours. So basically, you can come to one of our properties and see in depth, like, what the business strategy is, what the business plan is, how is it being executed, with real examples, like our properties specifically. You can come and see. So you'll have access to exclusive behind the scenes property tours. If you scan this, this is going to take you to a Google form. So when you fill out the Google form, that's gonna give you an opportunity to sign up, and we will send you the free tax guide. That will send you we'll send you an ebook on how to maximize tax savings through real estate. We'll send you a link to book a one-on-one call with Thanga and I. And then if you sign up, we'll also send you, and you'll have exclusive access to our future properties. So we're multifamily investors. We plan to continue to do it, and we've had a long history of it. And we would hope that if you want to, you can get involved.
Contact. Here is our contact. You can take a screenshot, just very quick, or pictures, whatever. And thank you all. Is there anything else, Daniel, you want to add?
No, that's it. Thank you so much.
Yeah, thank you all for joining. And once again, it's thanks to IAICC.
Yeah, Krista, if there are any questions, feel free to.
You think the tax credits in the One Big Beautiful Bill will help spur investment into new housing like Western Station that will help tackle the housing crisis across the U.S.?
That is the intention of the government. So if you see, they want to just encourage overall, government want to encourage the real estate investments. So more investment comes, more capital flows to the real estate, then more units will be coming in, more deliveries will be coming in. That helps our country to grow well.
Yeah, and also, Thanga and I, we're part of the National Multifamily Housing Council, which is the national, representation for multifamily owners and operators. And the two topics that are most concerning for them is, number one, how to build more affordable housing for the existing population, and two, how to introduce technology and AI into real estate. And so it's something that everybody's thinking about, and definitely the One Big Beautiful Bill, it has some other, specifically to your question for new construction, there are some more tax savings and opportunities for those that are in new development. Thanga and I specifically focus on existing assets, purchasing existing assets, but there's even more benefits for those building new construction. So yeah, hopefully that will help spur some more investment into new housing.
Okay, and there is another question now. I'm publishing it in the Q&A. It's a few questions. Have you filed a Form D with the SEC for this offering? Form D is the filing submitted to the U.S. Securities and Exchange Commission when a company is raising money through a private offering.
Yes, we always register our offerings through the SEC, the Securities and Exchange Commission, which governs how we raise capital. This project is a 506C offering, which means it is available to accredited investors. But thank you for that question. That's a great question. Sounds like somebody's an attorney on the call.
Well, and you just answered their second question, which is if it was a 506B or 506C. So that's
Yes.
a 506C. And then it also asks, are investors required to be accredited?
Yes, for this project they are. Yes, a lot of so that is one of the purposes of signing up for our little group, is because we oftentimes don't advertise these projects publicly. Most of the time, these offerings, these private offerings for real estate, you don't ever see them because we offer them only to our known group, only to the known people within our investor group that are already typically investors or know us. So a lot of the projects that we do, like he's asking, they're through a 506B, which means we have to have at least some relationship before you invest. So that's why, even if you're thinking about this maybe in the future or a couple of years out or something, it may be worth just getting on the list, and then that way, in the future, if it becomes the right time for you, you can take advantage of it.